G'day guys, it's Ben and Simon here. Welcome to another episode of the Pumped on Property Show. Now, I'm dead set pumped about this one today. I love talking about history and cycles.
Man, I'm so excited as well. This sort of stuff has given me more confidence than I could have ever imagined with my investment portfolio and with my plans for the future. So I can't wait to really break it down and get pretty granular on this one.
You know, you asked me off air, before the podcast, what has this understanding of this cycle stuff done for me? And it hasn't just helped me sleep better at night, but it's helped me invest better. It's helped me increase the returns. It's helped me set my family up for the future so much faster. So in this podcast, we really do get deep into terms of what is the cycle, where you can learn more about it, where are we in the current cycle, and why it is so important for you to have this information, particularly as we move through all of the ups and downs over the coming 10 years. I'm so excited, guys. I hope you enjoy it. And if you do, please give us a big 5-star review.
Welcome back to another episode of the Pumped On Property Show, everybody. We have been dealing with some pretty hectic weather up here on the sunny coast this morning. So we finally just got a little sunny patch. So getting straight into it because we've tried to record this 3 times today and then it's just downpour. Hey.
I'm so excited to record this one too. This is my jam. This is what I love doing.
Oh, bro, we're just talking about that off camera. It's I'm just so grateful that you found Phil Anderson. And I'm so grateful that Phil Anderson exists and he produces this type of information. So yeah, can't wait to talk about the cycle, where we're at, what's going to happen, everything.
For sure, man. So, let's start with that. For those of you out there, I know half of you would have heard our stuff on cycles before, or not our stuff, but Phil Anderson's, Ray Dalio, Fred Arrison's stuff. But, what is the real estate cycle? Is there even a real estate cycle is what most people would be thinking.
Well, look, in my opinion, I don't know. I don't personally know if there is a cycle, but I believe that there is a cycle because we've been following Phil for the last 4 or 5 years now, and he has been absolutely on point since we've been following him about this cycle, and everything has unfolded quite accurately towards his predictions. So I believe that there is a cycle and I am trying my best to trade it the best possible way. But, what do you feel as though is a cycle?
Yeah, so from my perspective, man, there are absolutely ways that money moves around economies.
Yeah.
And that's all we're referring to when we're talking about a cycle. So sometimes, like at the moment, money's really cheap and very, very easy to borrow for certain people. And that normally results in asset prices being stimulated. Mm-hmm. And then at other times of the cycle, money is harder to get and more expensive to get, and the rent returns and stuff don't quite look as strong as they do in, parts of Adelaide, Perth, Brisbane, for example, at the moment. And so it's less attractive for people to invest. And with the less demand or fear in the market comes the downside of every investment class, which is the lows or the losses.
Yeah, and it was actually really interesting when I did learn about Phil Anderson's 18.6-year real estate cycle. So Phil Anderson is an Australian economist that wrote this book called The Secret Life of Real Estate and Banking, where he looked at 250 years worth of research and history in the United States and came up with this idea of the 18.6-year real estate cycle. Now, over that 250 years, there's been some cycles that lasted 17 years, some cycles that lasted 22 years, but the average ended up being about 18.6. So, I sort of thought that was a little bit longer than any other cycles that I'd previously heard about.
Yeah, you look at stock markets, for example, and, generally you have a boom and then you get a bust like we've just seen with COVID, and then you get a boom and then you get a bust. Then, it's pretty clear that they sort of work in 7 to 10 year time frames historically. But I never had seen someone sort of link multiple periods in history together. And so what he found, big picture wise, is effectively we get about a 7 to 8 years up run from a global financial crisis where it's mainly your New Yorks, your Londons, your Singapores, your Beijings, your Sydneys, your Melbournes that do really, really well. The places where there's a lot of people, there's a lot of high income earners, and there's a lot of diversity in terms of the economy, and so it sort of gets on its feet. Plus, they're also the key centres of trade. The government artificially stimulates them first.
Of course.
And then they get to a point, like we saw in about 2018, 19,
Yep.
where, you know, they're pretty bloody expensive and not many people can afford them anymore. And we get some type of event. Now, in the past, we call this the mid-cycle slowdown. Coronavirus will be a mid-cycle slowdown point. What else have we had before?
The Twin Towers coming down was the previous sort of big event that kind of
The
sparked
dot-com
that.
boom as well, like at the same time.
Pre that was the Cuban Missile Crisis. Basically, that mid-cycle, generally there's some big event that sparks a lot of like negative sentiment.
For sure, man. And what we've found through looking at the history is normally the stock markets decline for about 9 to 18 months, as much as 20 to sort of 40, 45%. Real estate prices normally sit flat globally or even decline by a little bit like they did at the start of 2020. We forget that there was almost like a 10% decline in Sydney, Melbourne and Brisbane at the start of last year, but obviously it's gone nuts since then. And then we move into the second half of the cycle. Now, second half of cycle isn't quite as long, normally lasts about 6 odd years, maybe 7 years. And at the top, like particularly the last 2 years, people forget, because real estate prices particularly haven't declined for a while, that things are gonna get bad. And so everybody that's been sitting on the sidelines waiting, watching other people get wealthy in Sydney, Melbourne, etc., you know, come rushing in.
What about me?
What about me? I've missed the boat. They buy at a top, and this top is called the winner's curse, where, you know, it is a great time if you've bought way early, because prices go absolutely nuts for a few years globally. You know, that's normally stocks, it's normally like even other commodities, and it's definitely real estate. And then we get to a top where the banks go, uh-oh, like we've over leveraged ourselves.
Yeah.
You know, the governments around the world are in too much debt to bail everyone out properly this time round. And we get a contraction. Now, at the end of cycle, the contraction's far worse. So generally the stock markets decline and can be pretty bad for 2 or 3 years. They can decline by as much as 50, 60%. And then the real estate markets on average from the last 250 years have declined by 38% globally as well.
So I guess the like most recent record of this, the most recent time, and the most relevant for people to understand is the movie The Big Short. So this kind of explains the top of the cycle last time round, that winner's curse phase of the cycle, where you've got these investment bankers from New York going down to Florida, and, you know, every man and their dog, I think like the strippers or something, are investing and buying properties and leaving them vacant, just pure speculation. In debt up to their eyeballs with no income coming through, and then all of a sudden the banks come knocking at their door saying, hey, we want our money back, we've increased our interest rates, you need to pay us back a bit more money. And most people, well, a lot of people, not most, cannot afford it, and they have to foreclose.
100%, man. Like, this is the danger of this things. Like, you know, when you're looking at really cheap money, like a 3% interest rate, and you're interest only, like that might be manageable on $1 million. But if the interest rate gets to 5% and you've got a couple of properties and the banks are also like, hey, by the way, it's now principal and interest, all of a sudden your costs can increase on a couple of properties by 30, 40, 50 grand a year.
Yeah.
And that's also the time where a bunch of industries get belted and people unfortunately lose their jobs too. I remember during the GFC, I was working sort of at the end of it in IBM, and in that year they sacked 150,000 people globally, gone in 6 months.
Yeah, so there is rising unemployment at that period of the cycle as well.
Yeah.
And, you know, the last thing that you would ever want to happen as a property investor is, you know, let's say you buy the property at $1 million on an interest-only rate, you can afford the repayment, you're getting some good capital growth, then all of a sudden you get this decline and the property is now worth $800,000, yet your weekly, monthly repayments have gone through the roof because you're forced to go into principal and interest because the banks are coming knocking at your door.
Exactly, man. And so, you know, as an investor and, you know, as somebody who understands timing and cycles, not to the years and when things are going to happen, but the overarching concept is, you know, having a little bit of cash in the bank is an important way to get you through. Also, increasing your rent returns to the highest possible amount leading into it's another way to provide a hedge. You can talk to your accountants or your financial advisors about other ways as well. But the most important thing is if you can afford to not sell properties during that time, that's the number one thing. Like, you don't lose money unless you sell them at a loss. And so what normally happens is we go through this period of time where things went nuts, then they decline, or maybe they go flat in certain markets for a while. Remembering not all markets are equal. Some of the US cities in the last GFC went down by as much as 50%. Others went down by 6%. So it's like, it's relative to what's happened leading up to it.
Yeah.
And then, the carnage, as Phil calls it, is sort of wiped away. The balance sheets of the banks are reset. All of the poor assets have been flogged off at discounted prices. And then we go through the same thing again. And that's been repeating again and again in America for hundreds of years, and in Europe actually for like 300 or 400 years now.
Yeah, so I think it's really important to understand these cycles, regardless of whether or not how real they end up being, just because there's obviously better times to buy and better times to sell, better times to maybe get in a bit more debt, better times to avoid getting in too much debt. And, for me in particular, it's given me a hell of a lot of confidence understanding this cycle at a basic level with my investment strategy, because I understood when I was first getting into the market that we were coming into the mid-cycle slowdown, where typically property prices don't decline in Australia, but the stock market does. So, I knew that we were coming into this phase where money was going to get a little bit easier, money was going to get a little bit cheaper, there was going to be some form of negative sentiment in the market. But then the second half of the cycle, generally there's, mass speculation, mass growth in most asset classes. So I've gone like up to my dead in my eyeballs during this mid-cycle slowdown to really get ahead, and now I can move into a different phase of my investment journey, which is building up those buffers, putting myself into a bit more of a safer position, getting a bit more cash flow from those properties as well. So understanding where we were in that cycle gave me the confidence to go a little bit harder. And, now I'm finally starting to reap the rewards of that, which is great. But had I not known that, as I was saying before, I don't think I would have done what I've done.
Yeah, I completely agree, man. Like, I think that's a really nice segue into why it's important. Like, most importantly, it's given you sort of a blueprint, and myself one, as to when to take a little bit more risk. Risk is dependent on everybody's personal appetite, but when to go, okay, I'm going to have a bit more of a punt here, and also when to sort of pull back. And it gives you a bit of a pulse check on what's going on. Like, Phil's got these incredible updates through Property Share Market Economics that we receive each week. You can subscribe to them, and he's sort of telling us almost what's coming in 3 months, 6 months, 12 months consistently for the last 5 years. And so back in 19, I remember he said to me and everybody else that was subscribed, hey, 2020, we don't know what's going to happen, but it's going to be a really bumpy year. I'm personally in cash now. I'm consolidating. He even said as in the middle of 2018, hey, now's a good time to start, just getting yourself prepared just in case it's, it lasts for a couple of years. And, looking back now, we're almost going to be 2 years by the time we get out of this crazy COVID mid-cycle slowdown.
Yeah, we were super fortunate to get that information from Phil at such an early time. And obviously it's heavily dictated your investment strategy. Like, how is that, why is it important to you, and how has it helped you dictate your decisions?
It's a good question, man. First one is sleep. I've really, really enjoyed it from that perspective. Just understanding that there is a method to the madness.
Yeah, exactly.
The madness is people are so emotional, and people buy at the wrong times and sell at the wrong times, and they make decisions based on where the herd is moving. And so now that I'm aware that there's a pattern to the movement of people's money and the way that governments step in and out, I just do sleep a bit better. I was concerned during the last couple of years, like everybody else. It's been a wild ride, but also extremely bullish. I've never bought so many properties in a short period of time in my life. I really, same as you, went, well, hang on, some places, I didn't buy there, but some places in Sydney were down 30% at the start of last year. Other places were like down in Brisbane 10, 15%. You know, me and you took advantage of that, and that was beautiful. So the sleep thing's important for me. The also like knowing when to take a bit more risk and a bit more of a punt, and then to like when to like settle down, start saving a bit more cash, start, you know, fixing rates, start increasing rent returns, you know, when to renovate and when it's going to be worth doing something like that, or build versus just going, hey, I might just keep that 50K that I was going to put into that at the moment just in case like I lose a tenant or two like we both did during COVID.
Yeah, seriously. Now, what Phil actually did as well was like he created this property clock, and it was like a 24-hour clock, and it actually indicated what happens at different stages of the real estate cycle from the very beginning all the way through to the beginning of the next cycle. And you can actually go find that if you just type in Phil Anderson's property clock into Google, and you can have a look, and you'll probably be able to get that feedback as to exactly where we're at. And what I loved, what he put in there is the time in the clock, what happened, and what is actually going to be happening at that stage of the clock. And it was so interesting because generally around this stage of the real estate cycle, we start to hear the announcement of the world's tallest buildings. And I swear I saw like 4 articles last year for buildings in Australia, Asia, South America, where they're all the tallest buildings expected to be completed by the top of this cycle.
It's crazy, bro. That's one big indicator.
Yeah, and then, but he also indicates when government expenditure gets really hot in terms of infrastructure, when credit gets easy, when credit gets harder. So you can actually see exactly what's going to happen at all of these different stages. And to date, been on point within a few months.
It's been insanely accurate. Like, I'm such a skeptic and I'm so critical and I'm an analytical person, but I'm watching this and I'm like, it's been very, very helpful. And then you overlay that with what, you know, CoreLogic says, with what Ray Dalio's saying from an American context and like a share context, or, you know, what Fred Harrison's saying over there in Europe, or the amazing CBA updates that we get, or what the Australian Financial Review's at. And all of them are little pulse checks. And from that, you can make more informed decisions, reduce your risk profile, or potentially even increase your returns if you know what you're doing. So, you know, the $1 million question for everybody, and the first question that I would want to know is like, where the hell are we in the cycle right now, man?
Well, yeah, 18.6 years. You know, we are now, according to Phil, coming into what he calls the second half of the real estate cycle. So basically, the way that he's explained is this current cycle began in 2012.
Yeah.
The first 8 years of that was the first half of the cycle. That's where we saw asset prices in the stock market increase rapidly to record highs. We saw property prices in Sydney, Melbourne, New York, Singapore, Los Angeles, London go absolutely through the roof. And then come 2020, big event, obviously the coronavirus, which turned into a global pandemic that's still currently going on. So that was really the mid-cycle slowdown, which shook things up. We saw a big decline in the stock market. But luckily, property prices remained relatively resilient. Now, Phil kind of said, really like halfway through 2020, he's like, okay, look, things are starting to look okay again. Stock market began to perform well, and obviously the property market began to perform quite well also. So we are definitely moving into this second half of the real estate cycle at the moment. And when you look at what Catherine Cashmore is saying, what Akil Patel is saying, what Phil is saying, they believe that, you know, the next 4 to 6 years could be some of the biggest economic expansion we've seen in history.
It's incredible, bro. And what I want people to recognize, like, this is what I sort of didn't get when I first found this stuff, is it's not like this beautiful 8-year up run in property prices, then this perfect decline in stock markets, and then this beautiful run in stock markets and property prices and this big decline. Like, if you look at the 8 years of Sydney and Melbourne in the first half, they started off really slow, went crazy up till 17. Between 17 and 19, they went back 15%. Then between then and now, they've gone up by another 30% or whatever they've done. You know, if you look at the stock markets, like every single year for the last 20 years, there's been almost a 10% decline in each year.
Yeah.
At some point during the year. Like, I want people to get that, like, as we move into the second half, absolutely there's going to be shit times for property
Yep.
and stocks and really good times as well. It's the averages over a cycle that matter.
And this is why people don't believe in these cycles. This is why people don't, trust these things, because they look at those year-on-year performances and they're like, but, hang on, you said it was going to increase and we've just had a backwards year. And it's like, look, that's economics, right? That's how a market works. It's a bumpy ride.
If it was linear, we'd all be just making 10% a year and we'd all be retired.
But if you have a graph and you have your 18 years, and if you were to look at that graph over the 18 years, the common trend would be significantly upward.
What normally happens over a full 18-year cycle is in almost every major city around the world, prices of houses have doubled historically, and the stock markets have almost doubled. Now, there's so many different cycles. Some of them, stock markets actually sat flat for 15 years.
Yeah.
Other times, property prices didn't increase in value for 20 years. You know what I mean? It's like, it's so relative. You've got to sort of look at where you are, where the market that you want to invest is, and where that is relative to this bigger picture as well. Because we don't just go, I'm going to blindly follow this into Australia and, Cronulla Beach, it's the second half of the cycle. Let's go buy a joint for $3 million and get $750 a week in rent. We are looking at Australia and going, well, what did well in the first half? What historically does well in the second? We really like, Perth, Adelaide, Brisbane in the second half, mainly because they've been so subdued in the first half and incomes have increased, and there's people moving to these places that they look interesting to me and you.
Yeah, and that was one of the really cool things that we did, because what we got access to was that article from Homely where they looked at the 50 years worth of data in the 4 biggest metro markets in Australia. And what we did is we actually overlaid the 18-year real estate cycle over that 50-year period, and it told us exactly what Phil said. Sydney and Melbourne performed the best in the first half of the cycle. Brisbane and Perth performed better than Sydney and Melbourne in the second half of the cycle. And then you get information from Jeremy Shepherd, the director of DSR, where he looks at markets over a 20-year period as well. And, his feedback is that markets that have performed really well over the last 10 years have a less likelihood of doing well in that next 10 years, and vice versa. Areas that have done bad over the last 10 expect to do better over the next 10. So there's a lot of logic to that, and you overlay a whole bunch of different information to try and paint that picture, because as you said, nobody can predict the future. Phil can't predict the future. We're just trying to make the most educated guess with the information that we have right now.
One of the lines that he says, and I think it's on his email footer, is remembering the future. It's no one can predict it.
Love that.
It's just using the past to make better decisions moving forward. And there are a few canaries in the global economic system, in terms of the coal mine. Warren Buffett, every single time tells people what's going on a year before it happens almost. And he'll do that on Bloomberg, he'll do that on CNN, he'll do it everywhere.
Yeah.
Ray Dalio's done the same thing in terms of Ray's cool because Warren doesn't call the tone of the economy. He just calls, hey, it's toppy, I'm in cash again.
Yeah.
But, Ray's at that point where everything's service, and he's like, hey, it's toppy. Hey, it's actually much better than it looks.
Yeah, that was a really, really interesting one to see, Ray Dalio. So I believe it was early 2020.
Way early 2020.
He came out saying that he believes that there's going to be a 30% decline in the property market. He said this is going to be worse than the Great Depression.
Yeah.
Literally 6 weeks later, maybe, he came out and goes, hey guys, I was wrong. And he admitted that he was wrong. I love that about him as well. And he goes, I underestimated the amount of government expenditure that was going to occur, and I believe that we're sort of in a much better position than I thought we were in a couple of months ago. So it's cool to have these guys saying that stuff.
And that's what gave you and I the kick up the bum and the confidence to go, okay, if Ray's saying this, let's have a crack. So the next question, man, for both of us is what are we doing?
Yeah.
For me personally, it's super simple. I've done a lot of my accumulating in the first half of this cycle. At this point now, I did pick up one, I'd say it's last property, but I've said that before for this cycle. But it's a really nice property in a great location in what I think's been a massively underperforming suburb in Brisbane on the beach.
Yeah.
You know, once I've done that, my next intention is just to save a bit of money for a couple of years, because
Nice.
I have spent a lot of money and gone into a lot of debt to buy some assets. Once I've saved a bit of money, as we approach like closer to the top, I'll then go back and I've got to like knock down and rebuild a couple of properties maybe. I might also renovate a few. The intention for that is to just get them in a really good position for the next 10 years to not have to stress on them. The other like thought process there is I want to increase the rent returns as well. And, you know, realistically between now and then, I'll just continue to like slowly work off the debt, stack some cash in the bank, and try and get myself in a position where I've got a little bit of passive cash flow moving into it, and my overall position looks attractive to the banks, so that when the time comes and the market drops again and everybody's panicking like they were in 2020, you know, I'll be ready to get those stocks that I've missed out on. I'll be, you know, ready to get those other things that are on sale.
Yeah, I think it's really important to recognise that everybody's position is so different. Everybody's risk profile is completely different. And you did go extremely hard. You began investing basically at the beginning of this cycle. So you have gone extremely hard in that first half of the cycle, whereas other people that may not have been able to do that yet, you know, they're going to have a different investment strategy
100%.
to you. So, you know, this isn't a silver bullet. This is what we're doing. So this is what you need to do. This is just how we have traded it, because, you know, we've been studying this stuff for, you know, 4 or 5 years now.
Yeah.
You know, for myself, same as you, like I went as hard as I possibly could throughout the mid-cycle slowdown. So I picked up 4 properties from 2019 through to like the beginning of 2019
Wow.
to the end of 2020. So I am in debt up to my eyeballs. I'm happy to admit it. But at the same time, I knew it was the time to take action. So I've gone heavy into that. Now, over the next 2 to 3 years, I know that I've still got time in this cycle. So I'm going to be spending more money on those properties, adding some value to them, knocking down, rebuilding, because my strategy to get in was, let's buy the worst house on the best street in the best suburb, just so that I can control the land, and then I'm actually going to come back and add the value to it. So I'll knock down, rebuild, renovate, exact same plan as you know, add some cash flow, add some value to that portfolio. And then I'm going to spend the last 2 to 3 years leading up to the top of the cycle just pocketing some cash, offsetting some cash, decreasing those LVRs, increasing the cash flow, just getting myself into a safe position, the safest possible position that I can, investing in a bit of crypto over the next 6 years as well to use some of that growth to hopefully pay down some of the debt as well. So leveraging off the cycle, leveraging off the market to try and make that journey a little bit easier. But then my anticipation and my plan is to really take advantage during the next major GFC or whatever they choose to call it next time round. And that's where I intend to buy my dream home, which I'd love to build brand new up here on the Sunshine Coast. I want some west views. I want to be able to hear the ocean. A lot of KPIs there, but like I've got 8 years to plan for that. So
I love that,
you know,
man.
I'll find it. But then I would love to, really go heavy into the market as well. So I'll probably at that point in time, you know, pending stage of life, go back up to my eyeballs in debt and, you know, get some properties, get some shares, whatever I feel as though is the right asset at that point in time, and just go really hard, knowing that if things unfold the way that we expect, the way that Phil expects over the next 6 to 8 years, that I've probably got another 18.6 years from that point in time moving forward.
Doesn't it take the pressure off?
Completely.
Like, just going, hey, like there's good times and bad times, but the approach that we both have, and a question that I get asked all the time is like, are you going to sell everything before the top? And I'm like, there's 2 types of strategies that you and I both have. One is like a forever hold, pass on to our kids, or if they want to sell everything, like they can sell it and take the money. Or
maybe.
Yeah, like whatever, right? That's the best thing at the moment that I can think about them doing. It's like, and then the other thing is like playing the cycle. So I've got heaps of clients, right, that last year when Macquarie Bank was selling at $20 for example, now it's at 140. picked it up, or like Flight Centre when it went from like $25 to $3. Like, you know what I mean? And it's like they use that strategic time because they understood stocks to go buy it. Other clients I know have bought 5, 6, 7 properties over that time, and it's like they leveraged up on the Brisbanes, the Perths, you know, those strategic markets that have yet to do anything. And it's kind of like some of those people have got like a strategy to just, they bought a few years ago and they'll sell close to the top of Brisbane or Perth. Others, the same as me, are like, I'm just going to hold this thing forever. Like, ultimately, I'm not a speculator, I'm an investor. And I want to own properties completely outright that pay me passive income for life. And that's, I've got to remember that sometimes, because in a year when everyone's made 20%, you sort of get on the hype train of like, oh man, like,
should I be doing more speculation as well?
Like, that's dangerous. Like, what I really want is choices with my family, with my friends, training to do meaningful work, to help people. And it's like, the way you do that isn't through like riding booms and busts and hoping that what you buy is going to do well short term, but it's long term owned outright.
Yeah, and one of the other reasons I think it's really important to understand this cycle is the way it's taught us to invest. Because your original strategy was to speculate, it would have been to buy and sell, but learning this, we flipped it on its head. And our strategy is actually to accumulate the assets we intend to hold for the rest of our lives first.
Yeah.
So long-term first, because by going long-term first, it's harder to fail because you're holding these properties for the next 30 40, 50 years. It will work out over that time, but you just can't fake experience, right? You just can't fake researching, learning, buying. Like, you can't read those books and feel or learn about it. So you just got to do it. So if you can buy those, what we call foundational assets, the assets that you accumulate in the beginning of your journey, which will give you financial freedom in the future, then what you do is from there, and this is what both of us are moving into now and what we're talking about, is then now we've got a bit more knowledge about the market. We've got a bit more experience, nowhere near enough to confidently continue doing it for the rest, but we'll keep doing it and learning more as we go. But then with that experience, with that skill set that we've now built, I feel a bit more confident to speculate, to trade cycles a little bit more short term, to try and speed up that journey to financial freedom. So I think it's important to have a think about that and go, okay, well, where am I right now? How should I plan my investment journey? Should I speculate in the beginning with limited experience, or should I just go for the fundamentals in the beginning, knowing that at some point in my future I'm going to be a smarter investor?
I love that, man. You know, I know now through this education that, and we'll talk about where you can find out more about this in a sec, but like, I know that good times don't last forever and neither do bad. No. And so like when you're in the thick of the bad and everybody's freaking out, it is actually like once in a decade buying opportunity if you're in a safe position to do that at that time. And the reverse is also true. Like sometimes when it's a bit too hot in certain markets, you're like, I might just keep an eye on that one for a little while and wait for it to come back around. And that's the confidence that it's given me. Like, I don't own Sydney and Melbourne at the moment. I'd love to.
Oh, I can't wait.
I can't wait. And I'm so confident that at some point someone is going to be freaking out or over leveraged and has to sell a place at a ridiculously good price point, and hopefully I'll be in a position at that time to borrow a little bit of money and go buy it.
And you're not going to want to at that time, but you know you're going to have to.
Oh, it's scary as hell, but yeah, it's like just got to be done.
Buying in June of 2020 was just one of the scariest things. That was probably the scariest decision that I had to make, but like it's the Warren Buffett way, right? Be fearful when others are greedy and be greedy when others are fearful. So it's really important to recognize that. Now, let's talk about where we can find more information, because it is quite challenging to get onto this information.
For how good it is, it's fucking hard to find, eh? I'll start with books. So Phil Anderson wrote The Secret Life of Real Estate and Banking. Heavy to read. Must read. If you're like me, like go to the last chapter which summarizes the whole thing, and then if you like me, go and read each pocket of history.
I actually talked to another guy and I told him to do exactly that. And he goes, after you told me to do that, he's like, I just started from the beginning, because he's like, it actually gives me motivation to get to the end.
It's so exciting to get to the end of the book because it's really like there's 4 or 5 indicators that no one else talks about, like yield curves and tallest buildings and movement of money that are just so simple to observe. Crazy. So that's a good one. You know, Phil basically read a book before that called The Power and the Land, which was a 350-year study from Fred Harrison of booms and busts in the UK.
Yep.
Which was put out predicting the 1990 recession in 1983.
Yeah.
Then he wrote another book called Boom Bust, which was published in 2005, that predicted the 2007 financial crisis. So it's like he's already in his videos online on YouTube predicting the next top and bust.
Yeah.
Go have a look at his dates and, you know, take them with a grain of salt.
Yeah. Fred Harrison actually has a podcast, the Shepherd Walwyn podcast. And he gets interviewed by this guy and kind of explains his book. So the cool thing about Fred and Phil as well is Fred is an author, basically. So he writes really well. And he kind of makes it a bit easier to understand. But then Phil is an economist, so it's a little bit more tricky to read, but it goes really heavy into the data and the analytics.
Completely, man. Outside of that, like I've really enjoyed Ray Dalio's stuff. He's got a lot of good videos on YouTube. He's got 2 books which I think are worth reading. One is Big Debt Crises, which looks at 100 years and the I think 15 or 14 worst financial events in countries around the world, what led to them, what happens during them, and then how they recover. And it's a bit of an action plan for governments to be able to pull levers. There's 4 or 5 key levers that we see the government's pulling at the moment that re-stimulate economies. He also apparently just wrote a book. I haven't read it yet, but it looks at actually 500 years worth of history, booms and busts, from like selling flowers in Amsterdam 150 years ago as like the commodity and the boom and bust, to the cotton thing that happened in America. There's another really good thing on YouTube too by another author called Niall Ferguson called The Ascent of Money. And it talks about money from trading sticks all the way leading up to the global financial crisis and what happened. Again, like, it's hard to find. And you look at the views that these guys are getting and you're like, how the fuck doesn't the whole world understand this stuff?
I know, man. It's so rough.
But, like, they're good starting points. And then within each of them, their YouTube videos, and most of them have a newsletter you can subscribe to.
Yeah.
Their weekly newsletters are, like, absolutely gold for uncovering what's coming in a month in the future, and also just as that canary to warn you of you know what's happening a little bit before it happens.
So the 2 that we follow on a regular basis is Property Share Market Economics. You can subscribe there. You can pay to get more information, or you can just get their free updates. And then Catherine Cashmore, Cycles, Trends and Forecasts as well. She does free updates. I think she does a paid subscription as well, where she goes into a little bit more detail. And that's honestly one of the highlights of my week, is reading those ones.
Love reading their stuff.
You know, like, it is so much detail. It is connecting what is happening right now in the current market to another event that happened in the past, and what happened in the past after that event, which links to what could happen at this particular stage of the cycle as well. So it's just all relevant. And as you start to read a few of these different books, continue to read some of these blogs, watch the YouTube videos, you start to understand a bit more. And I think the penny dropped earlier this year, because it took me a while to really catch on to this, because I don't have as an analytical mind as you do. So I do struggle with that. So it took me a while, but the penny just dropped all of a sudden, and I'm like, it all makes complete sense now.
I remember that point. It was just like, man, we're having a chat on or off camera, and I'm just like, it's fully there now. And it's like, and it took me like a good 3.5 years.
It's taken me about 3-4 years.
And then not just to process, to go, what type of investor am I? Which was actually answering the question, what type of person do I want to be, and what type of life do I want to live, and what type of actions do I want to take, and what types of values do I want to hold? And it's like, because investing is just a way to access what you're supposed to be doing, right? Which is living the best version of yourself.
Yeah.
And it's like, we get caught up sometimes, and we've been really property focused for the last month, because I've been like investing like crazy.
You've been ready to buy.
And so I was like, property, but I'm like, hang on, this property is just one that I hope doubles over 25 years, that I can sell to make my future so much easier, or to hopefully own outright and have a passive income. It's not, it's my passion, but my passion is living a good quality life while I'm young enough to enjoy it.
Yeah, exactly. Not getting too wrinkly too young.
Yeah. I'm always like in these camera, I'm always like wrinkling up, and I'm like, my forehead's getting wrinkles because I'm always putting on this weird thing.
Oh man, every day I like watch these videos back. I'm like, man, you're looking more and more tired as you get older, bro.
Squinting into the soft boxes behind the camera as well. It's like...
But I guess, like, all in all, to wrap this podcast up as well, you know, according to Catherine, according to Phil, according to Fred, we are in a great stage of the real estate cycle at the moment. They do expect some really positive years moving forward, averaged out over the next 5 to 6 years. You know, I'm pretty bullish about the market. I've gone as heavy as I possibly can into the market at the moment. But the only way we're going to find out is with time, right? Time will tell.
You know, one of the best things I've heard from like Ray and from Warren is whether you buy at the top or the bottom of a market, over 30 years is irrelevant.
Yep.
It's, you know, this is just something to add into what you're already planning to do. Now, I had no idea of cycles and I was still buying property. And now that I'm aware of them, it's just, in my opinion, it's helped me reduce my risk as an investor and helped me take more structured action. But at the end of the day, like 99% of humans in the investment world don't even get any of this stuff. 99% of academics and economists don't even believe in cycles at all. Most people don't understand the levers that government, central banks pull, that businesses pull to manipulate the movement of money, to make things really bullish or really bearish. And it's like, just having a baseline understanding of this means that you can decide what you want to do. If you just want to be a buy and hold forever at any time, cool. But if you want to like strategically pick the eyes out of certain markets like we do, then, you know, you can really use this stuff to your advantage.
Yeah, and for my point as well, it's like when you see that headline article on your social media or on the TV in the morning of something, it's like they don't affect me at all anymore. Like I laugh at most of them nowadays. So it's like you see these things that would used to spike my anxiety or make me a little bit stressed. I'm like, oh shit, and I'd want to look into more information about it. Now I just go, cool, they're just headline hunting.
Yeah, and you know, the media cycle has to, like, I got a bit triggered by one that I've seen recently, which is just a little bit of forecast coming in the future from CBA. You know, a couple of the markets, I think Sydney and Melbourne, are pretty expensive, and it's probably like off the back of that, like in 2017 to 19 comes a little bit of a withdrawal, and seeing it like after not having a great night's sleep sort of spiked me, and I'm like, hang on, where are we at?
Yeah.
What's really going on? What's the projection of overall sentiment over the next 5 to 6 years?
Yeah.
Where is people's money? Where is government money at the moment?
Yeah.
Where's the allocation of funds and proper sentiment from institutional investors? And then I'm like, settle the fuck down, bro.
Yeah,
you know what I mean? Like,
down.
just relax and just keep doing your thing, which is the 30-year thing, not the this month coronavirus isn't selling anymore, so let's talk about property and put that in like as the negative on telly now.
Yeah, exactly. But no, I really love this stuff, and you know, I hope you guys can sort of understand this type of cycles. You know, I definitely recommend going back and listening to Ben's videos on the 18.6 year real estate cycle explained, Ben's interview with Phil Anderson on the podcast and on our YouTube channel. Go check out some of Phil's YouTube videos as well. And, you know, take it with a grain of salt and see how it makes you feel and see what you want to choose to do after that, because, you know, this has certainly helped us invest with a little bit more confidence, and it's certainly helped us identify growth areas a little bit sooner as well. And, you know, hopefully we can continue learning about this and diving into more detail and trading it quite well as well.
I love that, man. Like, I'll finish by saying one thing, and that's, I was watching Ray Dalio last week, and he said, you know, he's got like pure alpha strategy, which is like people that are young, that want to go hard, that are happy to take big runs and big declines.
The Grant Cardone and the Robert Kiyosaki way.
Yeah, it's like just go all in, and it's like that's averaged 20% a year for 30 years. And then he's got other strategies for more conservative investors, and the conservative model is still generated, like back tested, like over 9% a year, back tested for like 40, 50 years.
If
It's
I was
done
getting
incredibly
9%
well.
a year, I would be stoked.
You know, and that's like safe and it manages your risk. And the worst result over that 50 years was a minus 3% year. Like it manages that downside as well. And it's like, at some point as an investor, we've all got to decide who we are. Like all he's doing in the pure alpha is timing markets a little bit more effectively, where his, you know, more conservative strategy is just betting that there's going to be good times and bad times in certain assets always, and then getting the averages of those good and bad times. And it's like, I love that concept of like, you know, buy safely forever, or, you know, play the game a little bit more. But it's like, you know, I'm sort of playing a bit of both.
Yeah.
And I'm enjoying both too. Like it's fun to try and outperform the market averages because you buy the place that's only gone up by 2% a year for the last 10 years, as opposed to the place that's gone up 10% a year for the last 10 years. And it's fun to learn this stuff. Like it's exciting to know it. And I think the way that it can change your life and your family's life for the better is insane. And that's what we really want for everyone.
Yeah, I want to be investing for the rest of my life, and if I intend to do that and I want to keep myself and my family safe and financially secure, I'm just going to keep reading this stuff. I'm going to keep learning about it, and, you know, we'll see what happens by the time I die. Sorry to end that on a morbid note, guys. I do really think that this podcast deserves a 5-star review, guys, so please give us a review. You know, we're trying to get this podcast out there to more ears so they can hear about this different type of stuff. So please share it to a friend or a family member. And yeah, keep listening.
Hope you've enjoyed it. Cheers, guys. Not quite as smooth as the Joe Rogan
Outro.
Snoop Dogg one the other day, but we'll just wrap it up like that. Cheers, guys.
Sweaty. So sweaty.